Welcome to The Explainer. Today, we are cracking open a high-level institutional report dated March 17th, 2026, to get to the bottom of a major puzzle that's taking over the financial world.
On the surface, absolutely nothing makes sense right now. You've got major indices like the S&P 500 hitting new highs, while at the same time, all the headlines are screaming about stubborn inflation, geopolitical risk, and a job market that's slowing down fast. It's a huge disconnect, and today we're going to figure out what's really going on.
The report we're looking at puts it perfectly. The market is basically trapped in a giant tug-of-war between two massive forces. On one side, you've got the heavy, undeniable downward pull of stagflation's gravity. But on the other, you have the incredible upward thrust of the AI story, which is trying to achieve escape velocity and break free from economic reality. Okay, so here's our game plan for unraveling this thing. We're going to look at the economic drag from stagflation, peel back the layers on the market's so-called strength, find out where the smart money is actually hiding, and then lay out the strategic playbook for what could happen next. First up, let's really feel the weight of the stagflation gravity. It all starts with a very real and pretty nasty inflation shock. So, fresh geopolitical turmoil, specifically some major disruptions in the Strait of Hormuz, has sent Brent crude oil shooting past $103 a barrel. And what does that mean for you and me? Well, it means pain at the pump, with diesel in the U.S. now over $5 a gallon for the first time since 2022. And that energy shock, well, it's just pouring gasoline on the inflation fire. It's keeping core inflation stuck around this stubborn 3% level. And let me tell you, that is a red line that central banks simply cannot afford to ignore.
And this chart right here, this is where you really see the stag part of stagflation in action. Prices are high, but the economic engine is just sputtering. The job market is cooling off big time, with weekly job growth getting chopped almost in half because companies are getting nervous and hitting the brakes on hiring.
So you've got this toxic mix of high inflation and slowing growth, and it has put the Federal Reserve in a terrible spot. They're basically paralyzed. The report calls it a hawkish delay. See, they can't cut rates because inflation's too hot, but they don't want to hike them either and risk crushing the weak economy. And because of this, the market is now saying there's a 40% chance we get zero interest rate cuts for the entire year of 2026. So here's the big question. If this economic gravity is so powerful, why on earth did markets like the S&P 500 actually close higher? Well, this is where we start to pull back the curtain on the illusion of defiance, because what's happening under the surface is not what it seems. It turns out, the report reveals this rise wasn't driven by some great economic news or a burst of confidence. Nope. It was a technical mirage, a trick of the light, caused by a massive short covering event. All that means is that investors who bet the market would fall got squeezed, and they were forced to buy back stocks to close their positions. That buying has nothing to do with fundamentals. And if you want to see what's really pulling the strings, you have to look at the market's internal plumbing. It is kind of nuts. The whole thing is being controlled by these hyper short-term options. Get this, almost 60% of all options volume is in contracts that expire the very same day. It's creating this wild feedback loop where tiny moves can set off these huge automated waves of buying or selling. The tail is truly wagging the dog here. And here's another huge red flag. This rally is dangerously narrow. It's being held up by just a few giant companies. And even they are starting to look tired. I mean, take NVIDIA. They announced a fantastic outlook, and the stock still went down. It's like even the most powerful AI rocket ship is starting to feel the heavy pull of macroeconomic gravity. Okay, so if the stock market's big rally is just smoke and mirrors, where is the professional money, the real smart money, actually going? Well, the report gives us some very clear clues about where the big institutions are quietly finding safety. And this is the crucial point, right? Institutional investors, the big fish, they see this equity rally for what it is, a fragile illusion. They are not buying the hype. Instead, they're quietly repositioning their portfolios and taking shelter somewhere else. So where are they headed? First stop, a massive flight to quality, into traditional safe havens. This has pushed the price of gold to a stunning $5,100 an ounce. That's a clear signal of some deep-seated fear in the market. And the report doesn't mince words about this. It explicitly calls this move into gold a tail risk hedge. Now let's be clear, that's not just playing it safe or diversifying. That is buying insurance to protect against a potential severe economic or geopolitical collapse.
And this desperate search for safety, you can see the footprints everywhere. Money is pouring into government bonds, pushing their prices up. The US dollar is getting stronger, which basically sucks capital out of the rest of the world. And even alternative assets like Bitcoin are holding strong, acting as their own kind of digital safe haven. So let's bring it all together. With all these conflicting signals, what is an investor supposed to actually do? Well, the report concludes with two very distinct potential scenarios and a pretty concrete action plan. All right, so here's the strategic playbook. You've got two possible roads ahead. Scenario A is a temporary relief rally. This can happen if the Fed basically says, don't worry, we think this inflation is just noise. But then there's scenario B, a much more painful, real drop. And that's what happens if the Fed is forced to admit defeat and signals that rates are staying high. And the action plan for fund managers is incredibly direct. In that relief rally scenario, you lean in, you overweight undervalued stuff like small caps and financials. But if that real drop starts to materialize, it is time to get defensive. And I mean really defensive. Underweight the expensive tech and software and aggressively move into things like gold and build up your cash position to over 40%. The report is crystal clear on this. The single most important signal to watch for is tomorrow's dot plot from the Federal Reserve. You can think of it like the Fed laying all their cards on the table. It's a chart that shows where every single voting member thinks interest rates are going. It is the clearest map of their true intentions we are ever going to get.
And that really brings us to the final verdict from the report. All the short-term market moves, the day-to-day ups and downs, that's just noise. It's a dance choreographed by algorithms and whatever story is popular that day. But the long-term direction, the ultimate trend, is always dictated by the inescapable pull of economic fundamentals. It's dictated by gravity.
So, all of this leaves us with one critical question to think about as we try to navigate this incredibly complex and uncertain market. When gravity finally overpowers that escape velocity, is your portfolio prepared for it?